Let's talk about inventory, cost flow assumptions, and the inventory formula. Imagine there's a donut shop and that there's an employee whose job it is to sell donuts. He comes to work and notices that there's an old donut behind the counter. He goes out and gets 5 more donuts for the shop. So now he has 6 donuts for sale. These donuts look identical. Throughout the day, these donuts are being sold. At the end of the day, the employee has sold 4 donuts and there are 2 donuts left. Imagine there's an accountant in the back room and the accountant doesn't like to talk to the employee at all. The accountant knows that 4 donuts have been sold, but since she doesn't talk to the employee, she has no idea which 4 have been sold. She also knows that there are 2 donuts that are left in the shop. So, what can the accountant do? Before we go any further, let's talk about a couple of terminology. The first one is inventory. Inventory is a current asset, and these are goods that are held by a company for the purpose of sale to customers. Along with inventory is an inventory expense, and it has a very specific name called cost of goods sold. Inventory that is sold appear in the income statement under the cost of goods sold account, and we typically abbreviate it as COGS. The first donut that we have is what's known as the beginning inventory. When the employee went out and got more donuts, these are our purchases. Now we have 6 donuts, and these are goods available for sale. So that means we can sell these 6 donuts. When 4 donuts have been sold, they go into our cost of goods sold account. And at the end, there are 2 donuts left, so this is the ending inventory. So back to our donut shop. Our accountant knows that 4 donuts have been sold and 2 are left. What can the accountant do? Remember, the accountant does not talk to the employee, so she has no idea what's going on in the donut shop itself. As such, she has to make certain assumptions about the flow of donuts. There are 4 of them: specific identification, first in first out, last in first out, and weighted average. So let's go through them one by one. The first one is the specific identification method, and in this method, just imagine that we slap a sticker on each donut so the accountant can keep track of and know exactly which donuts were sold. But as you can imagine, this can become quite tedious, so really the specific identification method is only used for very unique items such as high-end jewelry and houses. First in first out is one of our major assumptions. It's also known as FIFO. This means whatever came in first got sold first. So let's think about our donut. Imagine that there's a conveyor belt. Whatever came first in the conveyor belt gets put in the beginning, so that's our old donut. And then for our purchases, the 5 donuts come in later. The old donut is also known as the beginning inventory. The 5 new donuts are known as purchases. Whatever came in first gets sold first, so under cost of goods sold, the first 4 donuts get sold, and they're the first 4 that falls off the conveyor belt. What we have at the end are the 2 donuts, and they belong into our ending inventory. Another cost flow assumption that we have is what's known as last in first out, or LIFO. This means whatever came in last got sold first. So let's imagine a cookie jar. At the bottom of the cookie jar is our old donut, and whatever we buy, we place on top of the donut. So our old donut is our beginning inventory, and our purchases go on top of our beginning inventory. Cost of goods sold is whatever came in last. So the last 4 donuts from the donut on top gets sold first. And then our ending inventory is whatever is at the bottom of our cookie jar, and that includes our old donut, which is also our beginning inventory. Our final methodology is the weighted average, and basically you just take the average of the 6 donuts. Let's think about the inventory T account. Because inventory is a current asset, the beginning balance is on the left-hand side of the T account. When we make purchases, we're going to debit inventory, credit cash, or if we don't pay our suppliers in cash, we credit accounts payable liability account. So the purchase amount goes into our inventory T account on the left-hand side or the debit side. When we sell the inventory, our inventory is going to go down, so we'll credit inventory and debit cost of goods sold. So the amount that goes into cost of goods sold gets credited in our inventory T account. And finally, we can find the ending balance. This gives us our inventory formula: beginning inventory plus purchases minus cost of goods sold equals ending inventory. And this concludes the inventory cost flow assumptions and the inventory formula.